National Trends Update. I'm Nick Elder with Ironton Capital. I'm joined here by Lon Welsh, founder of Ironton Capital. How you doing, Lon?
Fabulous. Thanks for doing this with me. Sounds good. So I'm going to go through the national trends, and the goal of all this is to give you hard data to be able to make real decisions as opposed to being reliant on what you get from hearsay or just fragments. One of the challenges in today's media is that everything is broken down to these little bitty sound bites, and a lot of concepts about what drives economics, interest rates, and the real estate market doesn't lend itself to simplification. I think it was Einstein that's credited with saying that things should be simplified as much as they can be, but no simpler than that. And there's, I think, some real warrant to that. We'll have a little bit of fun information at the very tail end, but really this is more about sharing data with you. All right, so I want to talk about consumer confidence. The residential real estate market is very much an emotional decision to buy real estate. And you can see the University of Michigan study for consumer expectations and sentiment has been very negative this year compared to the last 10 years or so. And they do a follow-on question saying, is it a good time to buy or sell a house? And you can see that the numbers are at very low numbers. And on the case on the buyer side, pretty much like a decade-long low. So August Wall Street Journal survey asked people, do you think that you could buy a house if you wanted to? And less than 25% said yes. 56% said they had little or no confidence that they could buy a house even if they wanted to. So part of this is people don't think it's a good time to buy. Maybe they think the rates are too high, or the economy is too uncertain, or they're worried about losing their job, or they're worried about tariffs. But a lot of them also just don't think that they'd qualify, which is really frightening. So we're likely to see malaise in the residential real estate market for a little while. What's interesting about this is a couple of really smart professors built an algorithm to predict what consumer confidence should be. And some of the big economic indicators in their formula were exactly what you'd expect: unemployment rate, inflation, consumer spending, and stock performance. And if you look at pre-COVID, up until 2020, the gray line, which is the prediction of what consumer confidence scores should be, higher is better, very closely tracked the reality, which is the orange line of what consumer confidence was reported to be. And ever since COVID, there's been this gigantic disconnect where people should be feeling better about the economy because the stock market actually is doing well. I mean, it's certainly volatile. It's always volatile, but we're at near record highs. The unemployment rate at around 4% is, historically speaking, good. Nothing wrong with that. Inflation is not 2% like the Fed wants, but it's less than 3%. And people are spending money, So the actual dismal rate of feelings, I think, is really driven by the headlines. So once we see some relief about the negative headlines about tariffs and things, maybe we'll see consumer confidence go up a little bit. So inflation, as I said, it's up a little. It's above the Fed target, but not dramatically so. Unemployment is still within the normal sort of band, 4% that it's been at for quite a while. Job growth is the thing that's slowing down. So the job growth recently has been very anemic and less than the economists' forecasts. And that's really what's sounding the alarm bells at the Federal Reserve and why you're likely to see some rate cuts in the near term on short-term interest rates. And the anticipation of that has actually helped the mortgage rates to go down a little bit recently, which has been a very welcome development for us to see. If you ask economists, and I've got a slide, I believe, about this later today that I'll show you guys, not very many, about a third, expect that we'll have a recession sometime in the next year. But if you ask just typical Americans, not economists, 2/3 think there's a recession coming. And if enough people think there's going to be a recession, eventually it becomes a self-fulfilling prophecy. So far, consumer spending hasn't been impacted too badly yet on day-to-day stuff, although certainly spending on homes and automobiles is a little bit slower. So we spend a lot of money investing for you, primarily in multifamily. So I want to talk a lot about what's happening with renters. Are they going to be able to become first-time buyers, or are they going to be stuck as renters? And that will drive a lot of prosperity for those of us that own apartment buildings. So this is the first of a lot of slides on that. So on the left, you can see a lot of renters are struggling to pay their bills. If you look at the lower left, if you had any bill in the last month that you were unable to pay in full, the red is the homeowners, it's like 11, 12%. The gray is the renters, 28, 20, 27%. So there's a lot of renters out there that are not paying all their bills. And if you're not paying your bills, you're sure not saving any money, which means you're not likely to be a home buyer anytime soon. What this means, and some of the other slides I'll show you tonight, is I think what you're going to see is a structural change where going forward, there's going to be a larger percentage of American households that'll be renters long-term structurally, and the number of homeowners is going to be less. That's going to fuel a huge amount of growth for the rental market. You can see early evidence of this on the right-hand side. This is the percentage of households that own, and you can see that the number of owners is declining and the number of renters is going up. So another thing that's a challenging headwind for all consumers in general and renters in particular is credit card delinquencies. We see that consumer spending has been stronger than income growth would predict. And what that suggests is that people are either pulling down on their savings or they're ramping up spending on credit cards to maintain their lifestyle. And in fact, that's true. Credit card balances are increasing over time, as are the delinquencies. So if you look on the right-hand side, here's a bunch of different categories of consumer credit. And you can see that delinquencies are up for most of them, and almost all that negatively impacts first-time buyers. If you guys have any questions as I go along here, feel free to drop a question into the chat box, and I'll try to answer the questions as we go. Otherwise, you don't want me just like talking nonstop for an hour. That'd be kind of boring for you, probably. Good news is that people that own their home find that that's usually the largest single creation of wealth for their family, anything that they invest in, and the magnitude of that wealth gap is only growing over time. As a result, if you ask Americans what's the best long-term investment, real estate is the number one choice, has been for a very long time and continues to be by an ever-increasing margin. So it's nice that people see the value of real estate because it's certainly something I believe in quite a bit. All right, that's consumer confidence. I want to share this. Do you have anything there, Nick?
No, I'm good.
So let's talk a little bit about real estate downturns. Is it likely to happen, and how severe will it be? Just so we clear up some of the miscommunications in the media who think that we're all about to die, which that's not actually the case. Oh, Adam asked, I'm surprised I didn't see crypto on the last graph. It is. Crypto is there in the lower right-hand corner. 2 or 3% of Americans thought that crypto was the best long-term investment. There's a lot of crypto fans out there that would disagree, but overall, America. Glad that you caught that. So here's 60 years worth of data, and this is the average price of a house in America. And you can see, back in 1963, even before I was born, and I'm an old person, average home price is like 25 grand, and now we're in the 425 sort of range. And you can see that we had some tough times in the last 60 years on really 4 different occasions. So in the 1980s, mortgage rates were really high because the economy was terrible, high inflation. And when the rates were at 18% for mortgages, buying sort of came to a halt. And as soon as the rates dropped, things spiked back right away. In 2006, let's say it's 2000 to 2006, we had extremely easy lending. And we had something called a stated income, stated asset mortgage, where you could just go tell your banker, yep, I make 150 grand a year. And the banker say, that's fabulous. Here's 600,000 bucks. Do I need a down payment? Yeah, don't worry about it. Just go buy something for 600,000 bucks, and people would go do it, even if they weren't financially qualified to do that. And most of them gave the houses back in foreclosure in 2007, 8, and 9, at least in the Denver market. Other parts of the country dragged on a little longer. So we saw about a 25% drop in home prices as a result of that stupidity. It took a couple of years to recover, but you could see that by about 2014, actually 2013, prices had fully recovered. So even that gigantic real estate shock didn't take long to recover. COVID, if you guys rewind to April of 2020, that was the maximum lockdown. We were all in our houses. We weren't allowed to leave. You weren't allowed to show any houses for real estate, so it's pretty tough to sell a house if you can't show it. So the real estate market ground to a halt for a couple months there. But as soon as we were allowed to show houses, things bounced back really fast. And our current slowdown, prices have eased a little bit, and it's mostly due to the interest rate shock of mortgage rates going up so much so fast. So there's an affordability side challenge that we're in, but also consumer confidence that we just discussed at length. So how long is this downturn in prices? That's not a crisis. Downturn in residential real estate going to last? So if you take a look at the red column in the middle, how much did the prices drop? And you can see that there's, how much did the home sales drop? So you can see that the volume declined from the peak on all these is somewhere between 25 and 50%. This downturn, our sales volume is off about 40% from the peak. Pretty material amount of change. I don't have prices on here. Prices have been down a little bit, but nothing like 2007 by any means. So for these prior shocks to the real estate residential market, how long did it take to recover? And the answer is somewhere between 8 months and 4 years. We're about 3 years into this current slowdown. I think we got about another year to go, but I think when we look back at this time right now, we're going to say next year that we're at bottom dead center is my guess. So if you guys want to bet a cup of coffee on that, I'll take that with you. So we're probably through most of the worst of it here on the residential side. So I'll pause there for a second, see if we have any questions at all. This might be a really short presentation otherwise.
No questions yet.
All right. Will prices drop? It's going to depend on which part of the country that you are in. So the upper left-hand chart is supply and demand. So we've got the sellers in the green and the buyers in the blue. And you can see this is the first time in about 12 years that we've had more sellers than buyers by a really healthy margin. But it's not equally true across all the US. So if you take a look at the lower right-hand side, the Northeast and the Midwestern parts of the United States are roughly supply-demand balanced. So you're not seeing inventories build very fast in those regions. On the other hand, in the South and the West, there's too many sellers, not enough buyers. So you're seeing inventories increase and you're seeing softer prices. Exactly supply-demand 101 like you'd expect. So
Lon, two quick questions here. One from Don here. Do condo prices swing up and down more than houses?
Yes, historically they have. Historically, the condos have appreciated just a little bit less than houses. It's really close, but there's a little bit more volatility. And the reason for that is that first-time buyers disproportionately buy a lot more condos, and it's usually trade-up buyers with more equity that tend to buy homes. So if you're a first-time buyer with like an FHA loan, maybe you're only putting 3% down. If you lose your job, you have to sell the house, even if it's a crummy time to do it, or else it's a foreclosure for you. Versus a homeowner, typically it's a first or second trade up. A lot of times they've got 20 or 30% equity. So there isn't the financial distress. The more expensive the real estate, the less distress there tends to be in a downturn. So that leads to less volatility on the higher end of the market. Great question.
And then question I've got, what do you think accounts for such a imbalance here in the South and West, and then the Northeast and Midwest? I mean, there's considerably more sellers in the South and West, which I'm guessing are more on, markets that are very expensive, maybe markets that people are moving out of, such as California, into more affordable places. I guess what do you think are one or two things that might account for this imbalance between the different regions?
You'll have a slide later on where we look at appreciation by state. And what you're going to see over the last 20 some years is that the Western states have had more appreciation than the rest of the country. And that's also been true over like the last 5 to 7 years. So I think a lot of it is just a pricing issue, that the prices have gone up so much so fast in the Western states, at least, that it's harder to find buyers that can afford it. And I think that gap is causing problems, as opposed to, I grew up in Iowa, not a very exciting state from a real estate standpoint. It goes much less appreciation, but much less volatility. So you're not seeing the dramatic swings in the Midwest. So I think that's probably the root cause of it. It's a great question. So if you look at the inventory levels versus pre-COVID 2019, you can see for the Midwest and the Northeast that we are negative. So what that means is that the inventory today is 40% or 50% less today than the inventory was right before COVID. So we're still a little inventory undersupplied in the Midwest. So since the buyer demand has softened everywhere across the board, since the supply didn't go up so much, supply and demand are more closely aligned, which has led to stable pricing. As opposed to, if you take a look at the South and the West, you can see that we had a big drop in inventory after COVID. There was that mania, and the inventory levels have risen back up. So what does it mean for home prices? Well, in the Pacific Northwest and the Mountain States, we have very little year-over-year growth in prices. And in the Mid-Atlantic and New England, you've got really strong growth. So just like you'd expect, if there's more sellers than buyers, you're not going to see a lot of appreciation. If we could forecast a year in advance and look at this chart, I think it's going to look almost identical over the next year. So that's inventory. You can get a copy of these slides from Nick. Nick, you might just drop your contact info
Yep.
into the chat box there. But this just sorts out which of the markets are doing the best. You can see, Chicago and Cleveland have got great appreciation, and Austin, Tampa, Miami, Denver have got slightly negative. So since there's too many sellers and not enough buyers, appreciation is really slowing down. That's really put a lid on asking prices. So after 4 or 5 years of really strong price growth, it's starting to flatten out, which is a really good thing. That helps with affordability. This chart is just a fun one. You may not know, if you are single and have an owner-occupant residence and it goes up $250,000 in value and you sell it, that first $250,000 is tax-free for you. And if you're married, the first $500,000 of gain is tax-free. But if you have any gain over and above that, that's going to be a long-term capital gains tax. So what percentage of the homes are going to be having to pay that? And this just shows you the chart by state. So you can see Washington, Utah, Colorado, California have had a lot more appreciation. So a lot more of the people in those states are going to have to pay taxes when they sell, as opposed to Iowa, where it's only like 10%. This chart really illustrates that conversation really, really well. So we saw earlier that about 2/3 of Americans think we're going to have a recession sometime in the next year. If you ask economists, the answer is, 35% of the economists think we'll have a recession. So the economists are a lot more bullish about the economy than the consumers are. If we have a recession, what does that mean for the residential real estate market? Well, the answer is probably not much from a pricing standpoint. In 2008, you can see we had a huge correction, but that's because the illness in the real estate market is what caused the overall economy to have a recession. But the rest of the recessions on my graph here, they're just like normal sort of recessions. And you see that on average, the home prices still went up, just not at a very dramatic rate. What happens to mortgage rates in a recession? Well, universally, they always go down as a stimulation effect to try to get more people into the market. I would guess if we have a recession, you might see a 1/4 to a 1/2 point drop in mortgage rates, but nothing overly big. You're not going to see rates go back to 3% or 4%. That's just not going to happen. All right. Any questions there? All smooth sailing. All right.
Nope. We just had a question. Wait, let me see here. So Joel, not weighing in with a personal opinion here, but we're seeing large companies already reducing hiring in the white collar and management jobs, with AI threatening to remove a significant amount of jobs from the general economy, be it in a few years or more realistically twice that time. How do you see the possible nationwide income loss affecting the market? For example, LinkedIn, the job search website, went from 12,000 employees last year to the CEO saying they're going 1,200 in 2026. So significant reduction in a short time, potentially.
Yep. It's interesting that you asked that, because there's been really good articles in both the New York Times and the Wall Street Journal that I've read over the last month, sort of tangential to this topic, partially among like people graduating from colleges, even really fantastic colleges with degrees that traditionally would be in demand. These people are having a really hard time finding a job, and a lot of the entry-level jobs have been the first ones to be sort of knocked out from AI. I don't know that AI has led to a lot of job displacement of people who are on the payroll, but as far as people trying to get into a job, like, it certainly seems to have a huge chilling effect on them. And then there was an article, I think it was in the New York Times yesterday or today, about people with a college degree. Historically, when they've been laid off, they find another job relatively quickly. And the unemployment rate among people with a college degree is usually quite a lot less than, say, high school dropouts or high school graduates. And that's not the case anymore. The unemployment rate among college grads is much higher than historically it has been. And it's hypothesized that AI is the driver of that. So, Joel, I think you're right. I think we're in the first couple pitches of the first inning of what kind of impact AI is going to have. But I don't see anything favorable from a job standpoint. I think it's probably all going to be negative. It's just a question of like how negative it'll be. What that probably means, though, is that incomes are going to stay stagnant, or there's a possibility where incomes could go down a little bit in composite. And that would increase the gap between how much income is needed to buy a house versus what's available in the general population. That would lead to less sales and more people becoming renters and fewer people becoming buyers. So as an apartment owner, it's all good news for me. What I see with AI, for people who own houses and have jobs, it's not attractive. That's a great question. So is there going to be a foreclosure boom? The quick answer is no. So if you take a look at who's in the foreclosure process, 0.1% of the homes in America are in the foreclosure process. So Colorado's at 0.1%, so just about the average. It's like Illinois is the highest, and South Dakota at 0.1. Wow, 0.01. That's like 6 houses in all of South Dakota. Not much of a problem there. So why is that? We're sitting on a record amount of equity. So the overall equity of the housing market in composite is a little over 32 trillion. The amount of mortgage debt is about 13 trillion. So there's, quite a lot of equity. If you think back to 2007, 8, and 9, we had a huge foreclosure process, which led to prices going down about 25%. Why was that? Well, in 2010, we were actually upside down as a country. The composite value of all of our mortgages was more than the value of all the houses. So if you lost your job or just decided not to make a payment, you couldn't sell your house because you wouldn't get enough proceeds to be able to pay off the mortgage. And that's why we had so many foreclosures. So you can see the balance sheet is so much healthier now. It's just statistically highly unlikely that you'd see a repeat of the 2000 crisis. Yeah. Interestingly, 39% of American households that have a house have no debt at all. And another, 29% have a huge amount of equity, better than 50%. So the amount of equity in our market is just mind-boggling. All right. Will rates go up or down? Well, recently they've been going down. So you can see that on August 1st, we had that current jobs report number get released. It was disappointing. And I think that was also the time when the prior couple months were revised downwards. And that's what really set off the alarm bells at the Federal Reserve. So a lot of speculation that the next rate meeting will have a cut in rates. So the mortgage rates you can see went from like 6.75 to 6.55. So that's a pretty healthy drop overnight based on that news.
I think that was too long. I think right around that time is when we saw, because keep in mind, guys, a lot of lending is based off like the U.S. 10-year Treasury.
Yes.
I think it was right around that time. I mean, if you look at the 10-year now, it's about almost
4.05 maybe.
Yeah, I actually just looked it up. 4.03 as of end of today. Yep. But it was only maybe around that time.
Where it's like 4.4 not that long ago.
Yeah, exactly. So do you think that's the market pricing in this upcoming Fed cut? Yeah, I thought so.
Yeah, I think that's what that mostly is. The Federal Reserve decreases in the short-term rate don't directly impact the long-term rate like a 10-year Treasury. And it's the 10-year Treasury that sets the mortgage rates. But it does help. And it helped a lot in this case, and that's definitely going to have a stimulating effect on our real estate market, residentially at least, which is nice.
We've got a question here. So any information on the commercial foreclosures, or are they mostly extend and pretend?
Anecdotally, it's mostly extend and pretend. So if you're with a small local bank, it's really a problem for a bank to have a loan in a non-performing category. A lot of extra capital they've got that they could be making more money with, like they're making more loans. They have to take that out of circulation and set it aside for loss reserves. So they don't want to have your loan in non-performing status. So they can give you a payment holiday. They can take your loan from amortization to interest only. There's lots of different tools they can do to try to help you out because they don't want the problem either, as long as you're communicating and working with them. So I think that the amount of distress is a lot higher than the commercial foreclosure rate would have you suggest. On the other hand, some commercial loans, particularly the larger ones, they're packaged up. It's CMBS, collateralized bank. I can't remember what it stands for. It's basically you take a bunch of commercial loans, package them together and you sell the whole package on Wall Street. Those are really strict contractual arrangements. And if you're behind on a CMBS loan, you're going to go into default and they're going to take the building back. So those types of loans, the mortgage rate, the default rate is higher. Good question.
Makes sense.
Yep.
I think in a lot of these extended pretend scenarios, right, Lon, like the bank's willing for the most part to work with the borrower, work with the owner. But what you're typically having to see is like that borrower's got to bring more skin in the game. It's not just a matter of let's extend your IO period another 3 years so you can make cash flow. It's like maybe we'll do that, but you got to bring in $1 million of debt reserve to accomplish that. And so you often have to go out, you got to go to your limited partners, raise more capital, whatever that case is. I mean, the bank at the end of the day, they own it. They own the deal. They own the property, so that you kind of have to adhere to whatever, they're going to tell you that they want you to do. So there's a lot of extending and pretending out there, but there's still some distress in the sense of, okay, you got to bring money in for debt reserves. You got to pay down the balance in order for us to qualify for this extension of your loan.
Yeah, absolutely.
Do the smaller banks, credit unions have stakeholders to be accountable to?
Oh, everybody's got somebody to be accountable to. So you've always got a regulator. Your CEO has a board of directors that, has the ability to fire them if they're not doing their job. So yeah, absolutely. So the markets are expecting 2 rate cuts from the Fed this year. The markets have a terrible track record of predicting this, but let's hope that they're right. Most of the economists are expecting rates to drop a little further. Yeah, they'll probably drop a little bit, not a lot. So the short-term rate we talked about by the Fed doesn't have a lot of impact on mortgage rates. It's more the 10-year Treasury that impacts that. So we talked about how the rates on the 10-year recently dropped about 4%. So it's the 10-year Treasury plus a risk premium. And that risk premium recently has been going down a little bit as well. So that's really good information. This slide is out of date. The mortgage rates right now are about 6.25. So just in the 2 weeks since I updated this chart, they've dropped a 1/4 point. This is a fun thing. So for those of you guys who are realtors, and there's quite a lot of you on here probably, in 1971, the interest rate was 7.3%. So you probably had clients saying that's an outrage, I'm not going to pay it. So if you waited for interest rates to go down, you would not have purchased a home until 22 years later, 1993. You would have had 22 years of renting, could have paid off your mortgage in 22 years. Meanwhile, the value of real estate quadrupled. So don't wait to buy real estate. Don't let the mortgage rates scare you off. All right, I want to finish off with apartment updates. This is our biggest section. It's got the things that will be most applicable to you guys. So on the supply side, we are chronically underbuilding new housing relative to the population growth of the country. And this chart on the upper left does a great job of illustrating. If you take a look at the number of housing units per 1,000 people, we are the worst among the industrialized countries at how much we're building. And if you take a look at the lower right, how does that supply balance sort of work out? A little less than half of the housing deficit is for sale, and a little bit more than a half is we need more rentals. So there's a lot of room to increase the supply of the rental pool with the housing demand that we've got. So how's pricing doing? Well, it's a great time to be a buyer. If you take a look at the 2009 to 2011 crisis that we talked about earlier, apartments on average dropped about 30% in value. And this most current correction that we're in, apartment prices have dropped about 20%. Looking at this curve, it looks like we're at bottom dead center and coming out at a very slow rate. Of course, you can't call a bottom until a fair amount of time after it actually occurred, but I'd be willing to bet that we're at the bottom for pricing. So great time to be a buyer for apartments right now. So that's that. On the demand side, I want to look at absorption. And absorption is just a fancy word saying we filled a formerly vacant unit. So if you had 2 people living together and they both got a better job and they decided, I want my own place. So they get rid of the unit they're sharing and they each get an individual apartment on their own. We've absorbed 1 vacant unit. If on the other hand, we've got 2 people with their own place, one of them loses a job, moves in with the other guy. Now there's an extra vacant unit. We've have negative absorption of one unit. So you can see in here around the first quarter of 2023, we had a couple quarters of negative absorption. So that means some people were giving up their units either to move in with a roommate or they're moving it back in with their parents. Recently, we've had a lot of positive absorption. So we're just gobbling up all of these vacant units at a really fast rate, actually at a record-setting rate. So it's really encouraging to see that. Demand has been very, very strong.
Note on this. Oh, actually, this slide goes right into that. So I'll let you go into the next slide because it really ties perfectly into, the absorption going up and then going down and then going back up again, how it ties into the supply demand that we've seen over the last couple of years.
Yeah, exactly. So on the supply side, this is the number of new units getting delivered into the market. So you can see 2024 was our record, since like 1971. And that by 2027, the number of units that will be added will be about 60% less than it was by the peak. So what's great about this is that we know exactly how many units are going to be delivered over about the next 36 to 48 months, because you don't just build an apartment building overnight. It's a very lengthy process to get your mortgage approved, have the architect build the plans, have the city approve them, bid it out for contractors, build the thing, and then lease it up. It's about a 3 or 4 year process. So if we take a look at the number of units under construction right now, you can see that it's quite a lot less than the peak was in 2023. So we know for at least the next 3 years, the number of additions of extra supply will be limited. But meanwhile, we've got really gangbusters on the demand side. So will that change? Well, it's unlikely, because right now raising capital to get the equity needed for the down payment for your construction project is very difficult. The overwhelming investor sentiment is, I want to invest my money in something that produces income on a regular recurring basis right away, has less risk because I'm not feeling confident about the economy, and I want the ability, liquidity-wise, to get my money back on short notice if I need to do that. I'm not excited about tying up my money for 5 years for a high speculation project. So you can see the amount of capital raised, that's the dark blue line, has really we're like running at about a quarter of what the industry was just 3 or 4 years ago. So even if you wanted to build an apartment building, you may not be able to raise the equity to do it. And even if you had the equity, a bank may not approve it. So it's not looking good for adding a lot of supply anytime soon. So something else that's really helping out the apartment community is that they've doubled down on retaining residents. So what this chart measures is when someone who's an existing tenant in your building, their lease expires, do they decide to stay with you or move away to someone else, the competitor across the street? And I think a lot of the owners have very wisely said, we may have to give like a month's worth of free concessions if we attract somebody new in. Plus, we've got the headache of cleaning the unit and fixing it all up. It just makes more sense for us to really work hard to retain our current tenants. And maybe we give them like 2 or 3 weeks free as a signing bonus if they renew their lease for another year. There's a lot of deals like that in the market right now. So you can see that apartment resident retention is at about a 3-year high, and that's doing a lot to help keep buildings full. It's just good management, I think, all the way around. So, the rents are expensive. Wouldn't you expect that a lot of these people will be going out there and buying a house? And the answer is probably not. So if you take a look at what's the average price of a house in America, it's about $425,000. What's the average mortgage rate? It's about 6.25%. What's a typical down payment for a first-time buyer? About 5%. You can solve for what would the monthly payment be for that typical situation. And what this is doing is comparing that house payment with I think the interest and taxes are included as well, to the average rent. And what you can see is that the average starter single-family house, the monthly payment is 97% more than it would be just to be renting. And it's just about the biggest gap that we've seen in the last 20 years. So if you take a look at that typical $420,000 house, how much of a household income would you have to be able to afford the payment? And the answer is about $120,000. Well, the average median household income is $85,000. So it's about 40% more expensive to buy a house, the income requirement, than the average American household makes. So great, we've got 46 million households that rent. How many of these guys make that kind of money? And the answer is 13% of them do. So about 13% of the overall rental pool has got the income required to buy a typical starter house. So I don't expect to see a lot of leakage of people who are renters into becoming owners. I think they're going to be mostly stuck with us as landlords for the foreseeable future. And you ask, like, why is demand so high? Because nobody can afford to buy a house. That's the root cause of the majority of it. It's a really fantastic chart for illustrating what's going to happen to the rental economy. So the other headwind is that there's a lot of debt. What we're seeing is that consumer spending is staying very robust, even better than you'd expect given the rather anemic gains in income across the economy. And getting to what Joel was talking about earlier with AI, there's a threat to what the income levels might be that could go down a little bit, right? So if the consumer spending is growing and people's income isn't, that either means that they're withdrawing money out of savings or they're putting more on their credit card balance, because there's only so many ways you can balance out your household budget. And the answer is they're spending more on their credit cards. That's how they're funding this gap. So as a result, if you are not saving money, you're working through your savings, you're putting more money in your credit card, it just wrecks your credit score. And it's just like one more reason why you're not going to be able to buy anytime soon, which means you're renting from us. So this is the chart showing you the trend line for median income. That's the blue line on this chart. And then the orange line shows you the requirement for income to afford the typical starter house. And that gap has gotten really huge over the last 5 years. And that's it. So I think this is a fantastic time to either be building new apartments, particularly if you can build them at a relatively affordable price for workforce housing, or if you could take an existing building that's been neglected and we could spend $15,000 per unit doing a renovation, and all of our competitors are charging $400 a month more. I don't care if there's a war in Ukraine or who wins in the White House or what happens to interest rates or what the Federal Reserve decides to do. If my crummy looking apartment building, if I renovate it so it looks as nice or better than my competitors, I'm raising the rent $400. I can control my own destiny. And I really like having an investment like that in this type of economy. And that's why we're all here. Nick, if somebody wanted to schedule a time to talk to you about, I've got this rental property, my lease is up soon, I'm trying to decide if I should renew the tenants or sell it. What would you do to kind of help them think through that? And how do they contact you for that?
Yes, you can go to this link, irontoncapital.com/more-listings-YC. You can also go to irontoncapital.com/IC-analysis. So a lot of investors, what they'll do, just had a conversation today. They'll say, look, I've got my tenants moving out in November. I'm looking, I want to see what my options are. I don't want to be a landlord anymore. What do I do? So I'll collect about 6 or 7 pieces of information. I'll plug it into an analysis, and I'll show you what that wealth accumulation looks like by keeping the property based on your returns today, or selling that property, investing in our long-term growth fund or our medium-term income fund that pay out or they return about 16 to 20% a year and 11 to 13% a year, respectively. So if you've got tenants that are about to move out and you're asking the questions, do I really want to rent this out again? Do I want to be a landlord anymore? But you don't know what the numbers look like with some of these decisions, feel free to reach out to us, and I'm happy to. I'll run the analysis for your rental property. We'll spend about 45 minutes reviewing those numbers. And the intention is to give you guys more data that ultimately backs whatever your decision may be. So if you have any interest in that, you can go to either one of these links and we can set up a time to review your property.
Perfect.
Adam, other than apartments, what is Ironton Capital looking for? Any office conversions or buy and hold to scrape and build?
So we have a short-term and a medium-term income fund. If you just need a quarterly dividend payment and a good amount of liquidity. And then we have a long-term growth fund. And our goal there is the money's tied up for about 5 years, doesn't have any liquidity to it. And the goal is like a 17 to 20% annualized return. That fund, we try to get a basket of about 30, 35 different commercial properties, ideally about across 10 states or so. Usually about 2/3 will be multifamily and the rest will be industrial, hospitality. We really like extended stay hotels, self-storage, and student housing. And then across all that, usually about half is new construction and half will be heavy renovation of an existing asset that's really been neglected.
Yeah. Adam, a little bit on that second question too. Of all the projects we've invested in, one of them is an office to multifamily conversion, actually in Harrisburg, Pennsylvania. The tricky thing with those types of projects is you have to be able to basically buy a building for pennies on the dollar when you factor in
Which
the
they did.
renovation. Yeah. The whole idea, the fantasy idea that was circulating is like, let's just turn all these downtown buildings into apartment buildings, but that's much less feasible than the headlines made it seem to be. So those are very hard projects to find, but we've done them. And we did a Bonnie Bay project as well, a single family luxury home build. That was a scrape and rebuild. So Don, do you have any funds or tenant in common or DST like funds that we could go into through a 1031? Or is it better to just pay the tax and go into something else?
Yeah, so actually that's part of the financial analysis. We gathered the historical returns of DSTs. That's called a Delaware Statutory Trust. So one of the great things about a Delaware Statutory Trust is you can sell a rental property and then do a 1031 exchange and defer your taxes and put it into a DST, which is a professionally managed, like usually it's like a large retail, like a Home Depot or a Walgreens or something similar to that. So we gathered up the historical returns of all the DSTs. So that's one of the options we can show you if you were to sell your rental property. Another option is you could sell, you'll have some capital gains tax due. Our long-term fund gives a lot of depreciation, and you can use that dollar for dollar. I'm not a CPA, check with your CPA, but everybody I've talked to so far has found that dollar for dollar, the depreciation we give them can be used to offset your capital gains tax. So it's not quite as good as a 1031 exchange, but it's very, very close. And then it gets a much better return. We'll show you exactly over 10 years, like how much better it'll be. So we can model that for you. And I'm 90% of the way through writing a book about exactly that topic. So I should have that for you. I'm hoping like in a month or two.
Yeah, so Don, if you want to run that analysis, you can, reach out to me directly, or you can go to this URL here to start the conversation.
Good question. All right, guys. Well, I'm super grateful that you would take the time to be with us in the evening, and I look forward to seeing you next month.
Yep. Thank you, everybody. Appreciate you being here.
Thank you. Bye.